So make this a little bit bigger so it's easier to see. Start with TFI. Again, relative references are key to doing it very quickly. So everything is its own tab. Copy and paste the relative references. What's key to the first part is following Modigliani-Miller. We want to put all of the operating items together, and we want to net the assets against the liabilities. Then we want to take the non-operating items, put them together, netting assets against liabilities. Debt, same thing. Equity, same thing. So in terms of doing this, to be honest with you, it doesn't matter if I add or subtract categories. It's a very similar process. Right? And that's where the labels will help you, and I will give you the labels. So in this case, when we do the operating invested capital, we look on the balance sheet for anything that is labeled A1. That is an asset. Right? So we got receivables, inventory, current assets, and I'll go with the working capital method that we talked about at the end of class last week. Anything that is a liability, that's current, so is my accounts payable and other current liabilities, and that will get me something called operating working capital. All right, so when I copy and paste these over, and this is important by the ones being all together, it's anything that is an asset minus anything that is a liability. And this is where it can benefit you because 1, 2, 3, 4, 5, 6 ones. I can quickly go back and see I have 1, 2, 3, 4, 5, 6 ones that are in working capital. All right, so by almost counting the ones, counting the labeled items, I know I don't forget things, right? Because inevitably I could just be very fast. I could skip over something, make a mistake. All right, then I'll put my long terms on here. All right, for purposes of the midterm, you don't have to break out working capital and long term. You can put all the assets and then net all the liabilities. I'm just following a format that we'll use more after the midterm, but same process. Anything that's a longer term asset, in this case, net PP&E, goodwill, and other assets, those are my ones. Anything that are liabilities, my liabilities would be my other long-term operating liabilities. Those are my ones, and again, same concept, copy, paste these over, right? So that I have my invested capital is the operating working capital plus this minus this. Now, here's the other way you could do this, right? Now, I didn't do this in the example last week, but and I didn't put this in the uploaded solution, but I did this in the earlier class if it helps you. I could always call this my long-term operating capital. So that I take the net PP&E plus the goodwill plus the other assets minus the long-term operating liability, and then I could basically say add that plus that, and I could still get the same answer. Now you might say, well, why would I do it this way versus the other way? And the answer is I was kind of being a little lazy when I did the initial setup last week, and to some degree even with the solution, because as you're doing this, if you're comfortable doing it the way that I initially showed you, that's fine. But if it helps you to see what's going on by writing in some extra sums and rows, then that might help you. So for example, what is invested capital? Invested capital is the cash tied up in the working capital plus the cash tied up in the long-term capital together is the overall invested capital of the firm. Okay, so I have my long-term capital, I have my working capital, I add the two together. You don't have to do that extra step, but if it helps you understand what's going on, writing in extra lines may not be a bad idea. Okay, do the same thing with my non-operating assets. Anything labeled 2. So in this case, I have 2. I have excess cash. And then I look on the asset side, and I have equity investments. And then I look for my liabilities, and I have one liability that's a 2. And same process, I want to net these out, my 3 2s. Now again, I could call this my non-operating capital as a row if that helps me understand what's happening here. So I could take the assets minus the liabilities, and that is my non-operating capital. So I have my operating capital, my non-operating capital. When I add the 2 together, TFI. Okay. So again, what I've added here is I've just added the concept of adding the non-operating capital. What we did last week when we first set this up is I just completely summed them up and I didn't have a separate category, right? It's not a question of right or wrong. I'm just trying to make it, for people that were struggling, easier to see what we're actually adding and subtracting together, right? Back to the next section, I need all my 3s and my 4s. Anything that's a 3, debt off the balance sheet, short-term debt, long-term debt, anything that's a 4, minority interest all the way through treasury stock. Those are my 3s and my 4s. If I did it right, my 1s and 2s equals my 3s and 4s. So again, this is my operating capital, this is my non-operating capital, and this is how I'm financing my total capital. Right? That is the rearranged TFI that we were creating. I think that took about 8 minutes. You have 90. Find out 90 is a luxury of time on this midterm. No one's laughing. It's okay. Yes?
So what you're saying is that on the midterm, we understand the top part, the 1s and the 2s can look like the 3s and the 4s all just one big
That's correct.
So let's have one big paragraph, TF5, nothing there.
Correct. That's fine for the midterm. After the midterm, we will get more granular like I'm doing it here. All right, and as I said, this is kind of more the way we think about it from an analytic standpoint. But for purpose of the midterm, what I really care about is, can you put things in the right bucket? All right, and can you give me the totals of the buckets? Like how we actually rearrange the buckets, I'm less concerned with on the midterm. I will be more concerned with later for analytics, but for now, less concerned with because we're just kind of getting started. All right? But if you want to be more advanced and write it out this way, you're welcome to do it this way too. All right? Now, that was TFI. Second, we want to do the same thing with the income statement, TII. Again, make it a little bit bigger, a little easier to see. Equals my 3 years, relative references. So what do we start with? We start out with our operating profit, which in this case is my EBIT. That was my 1. What was my tax on EBIT? Well, my tax rate right here is 30%. So equals that times 0.3. So my NOPLAT equals my 310 minus my 93. That's my NOPLAT. All right. So from here, those are my 1s. Right. Now I want to do my 2s, my non-operating items. Right. For my 2s, I go back to the income statement and I see there are 2 2s. One is interest income and the other is non-operating income or loss. All right. Now, here's an interesting question. Interest income is labeled as a 2. Interest expense is labeled as a 3. Well, they're both interest. Why wouldn't interest income be labeled a 3? Just kind of conceptual. Why would we treat interest expense as a debt cash flow, and why would we treat interest income as a non-operating cash flow? If it's interest, why not debt? Because when you think about accountants, sometimes they'll call it net interest margin, and they'll take the interest expense and the interest income and net them together in the accounting world, and we're not doing that here. Yeah.
It's because the interest expense is a finance activity.
Interest expense is a financing activity, exactly, but why is interest income not a financing activity?
Because that's just interest, investing in activity.
It's an investment activity, and then here's another clue. Where does interest income come from on the balance sheet? So let's go back to our balance sheet. This is our balance sheet. Where is the interest income being generated off of? Yeah. Excess cash. And so we want a consistency. Excess cash is a non-operating investment. Non-operating investments generate non-operating income. So 2's in the balance sheet, the 2's in the income statement, that should be consistent. If we treated it like a debt cash flow, then we'd have the non-operating asset, a 2, being a 3 on the income statement. Right? So this is again where we'll differ from the accounting world. Right? Because the accountants will just net out the interest expense. In our case, we don't want the net interest expense because we want to associate the cash flow. And whether it's called excess cash or whether it's called equity investments, it doesn't matter. The idea is I have a non-operating item generating non-operating income, which will generate non-operating cash flow. That's the consistency of the flow in the rearranged statements that we're trying to put to work here. Okay, does that make sense to everybody? Okay, so in this case, going back to our TII, we're going to have to pay taxes on the interest income, which gives us an after-tax interest income. And so at 30%, that would be the taxes paid, and that would be our after-tax interest income. Now, for the non-operating gains and losses, same process. So again, I have a non-operating gain or loss. I have the tax on the non-operating income equals that times 0.3, and that gets me my after-tax non-operating income equals that minus that. Now, somebody had asked earlier, well, can I just net the two? Can I just add interest income, add non-operating income together, and then do the tax on both? And the answer is yes. Yes, you could. Although I call that intermediate because when you're a beginner and you're just learning this, it probably is more helpful to write it out line by line. But just like I did with working capital, if you want to sum things together that have similar impacts and then multiply by the tax rate, it's not anything technically wrong with that. And as long as you're getting to the right TII, I don't care. But again, you got to understand what you're doing here. And that's what's more important to me as we get started. Because, and again, I'll add a line that didn't exist before, but I basically have my non-operating income total, which equals the after-tax interest income plus the after-tax non-operating income, and that gets me my TII. So basically it's the NOPLAT plus the non-operating income, and that should get me my TII. Copy, paste. There we go. Okay. So you'll notice on the solution for TII, I did it in a little different way. All right, so I just gave you the 247.8, so I had the same answer, but but I didn't sum up these non-operating items. Here in class, I did because I thought it was more helpful to the previous sections to see that that's actually what's happening here, right? But think about what we've just created, right? What we've just created is I have this operating profit, which is coming from these operating investments. I have this non-operating profit, which is coming from these non-operating investments. I have the total profit from operating and non-operating activities that is coming from the total investment in operating and non-operating assets in the business. Okay? That, in a nutshell, is the rearranging that we've done. It's a little bit cleaner understanding of the business. As I said, it makes the understanding of the analytics more straightforward to see what's really happening here with this business, right? Because in the other versions that we typically get from the accountants, things are mixed together. Right? And in this case, we're separating out everything, right? So, again, same thing with the debt cash flows. So, equals anything that's a 3. Well, there's only one 3 that's a debt cash flow, and it's called interest expense. Right? And that is a 3. And as we talked about it before, payments, since we have to match, are positive numbers. So I flip the sign. I have my tax shield on interest because I'm going to deduct that, so I'm going to save 30%. So that gets me my after-tax interest expense, which is the 54 minus 16.2. Okay. Then I go, those are my only 3s. Now I go and I look for my 4s. All right. On the income statement, my 4s are basically minority interest and net income. Now here's the thing. Listed on here are preferred and common dividends, but they're listed after net income. Right? And we got several people over the weekend who emailed us and basically said, I can't get it to balance, can you look? And the short answer is they put dividends on the TII, which is why it never balanced. Right? So here's the key. Income statement ends with net income. So anything listed below net income is not part of TII. Right? And that's just something that you'll have to get used to. Now, traditionally, preferred dividends are usually part of net income and common aren't. And we simplified this example homework to put both dividends after net income. But generally, just wherever you get to net income, that's where you stop with TII. It's just the format and nature of the statement. Okay, so that's why some of you had trouble balancing because you put in dividends that are not part of TII. They are part of CFI, but they're not part of TII. Okay, so back to this. Minority interest is a distribution. So it is a positive number. Net income is what belongs to the shareholders, so it's also a positive number. So when I add my TIIs together, I should get matching statements. That took 15 minutes, a little longer because I'll do more explanation here, but we still have an hour left to do our CFI. So before you get panicked that 90 minutes is not enough time in the midterm, notice how quickly it goes. Yes? That was actually going to be my question to the group. So what is minority interest? Can somebody help answer that question? Just in general, because minority interest shows up in the income statement and balance sheet, but where does it come from to begin with? Yep.
It's when a separate entity owns shares in your company. Is that right?
Yep. Yeah. Has to do with, so if you think about acquisitions, minority interest shows up when we buy something that we don't buy 100% of. Okay, so we buy a piece of it. Right? And then the accounting rules change based on what's called control. So if we buy part of a business, but we don't control it, then it's an equity investment. Right? It's an asset. Right? If we buy part of a business, but we control it, meaning more than 50%, then we treat it as if we bought the whole thing. We actually absorb all of the assets and we absorb all of the income into our business, right? But then two things happen, right? Number one, some of that income does not belong to us. It belongs to the minority shareholders for the business that we control, right? So what happens on the income statement, it's just GAAP, is that the government and the accountants want us to pay the taxes since we're controlling the whole business. Then we make an after-tax distribution, which is really a dividend, to the minority shareholders for the portion of the earnings for the business that we have absorbed. Now here's what's key. Those minority shareholders do not own the profits for all of our business. They only get the share of the profits for the assets that we have absorbed and that we control, hence minority interest. So we figure out our total profits, which include the minority assets. We pay taxes on that as the controlling entity, and then we dole out some of that minority income to the minority shareholders who didn't have control but are entitled to some of those profits, not all of the profits for the business. Simultaneously, on the balance sheet, we have a liability to the owners of the firm because they have an equity stake in those assets. And we have to report the equity stake they have into those assets as equity on our balance sheet, except it's not common equity because they don't own a piece of our entire business. It's only the equity and the assets that we've absorbed. That's minority interest on the balance sheet. Okay? So basically, on that company's balance sheet, it's an equity investment. On our company's balance sheet, it's a minority interest. And it is equity. But it's interesting because in a way, I have a foot in both worlds in the accounting side. Because minority interest is what I owe to somebody else's shareholders. So it's a liability, but it's an equity investment that they have been made. So right now, under FASB, minority interest is classified as equity. But I remember reading somewhere that FASB, under GAAP, that FASB is considering changing and reclassifying minority interest to be a liability, right? Because technically, even though it's equity, it's actually money that's owed to somebody else's shareholders. So it's really a liability of our firm to somebody else as opposed to equity in our firm, right? Because they don't control all of the assets. And that's what I mean by you kind of have a foot in both worlds. It sits right between the liabilities and equity of our firm. And to be honest with you, whether you classified it as a 3 or classified it as a 4, it won't change the valuation. Right? What matters most in the valuation is priority. What are the priority of the cash flows that we're going to pay? Right? Because if we were doing a cost of capital, every one of those things would have a cost associated with it, and then the lower the priority, the higher the opportunity cost. Now, we're going to use a WACC, so therefore we really don't care, because the WACC should include all of that prioritization. But regardless, that's what minority interest is about. And by the way, if you wonder what Part B of your midterm is, this is Part B of your midterm. So I might say, explain the difference between balance sheet and income statement minority interest. And that's an essay question. Right? So that's the difference between Part A and Part B. Do you actually understand what you're calculating? So you're not just plugging and chugging. All right, so other questions about that? Hopefully pretty straightforward. All right, so back to this. Got our TFI, got our TII. Now we go to statement number 3, the one that many of you had challenges with, which was the CFI. Create this as a new tab. Make it bigger so you can all see. Relative references. All right, so again, process. If I go back to what we talked about last week, cash flow is basically cash from the income statement minus cash reinvested in the balance sheet. Therefore, cash from the income statement minus changes in balance sheet. That's how you get reinvested in the balance sheet. It's the change in the balance sheet. Okay. So what we're going to do is we're going to go through this process 4 times. For operating activities, for non-operating activities, for debt activities, and for equity activities. Cash in the income statement minus change in the balance sheet. All right, so that's what's happening metaphorically. We come up with a CFI. Here's another question. If I give you 3 years of data, income statements and balance sheets, how many CFIs can you do? Why? Why can you only do 2? Because you're missing the 2012 balance sheet. Okay, so you can give me 3 years of TII, you can give me 3 years of TFI, but you can only give me 2 years of CFI. All right, because again, the cash flow is based on a change in a balance sheet, so you'll need 1 more balance sheet. Now, if I gave you 4 balance sheets and 3 income statements, you could do this. But with 3 income statements and 3 balance sheets, you can only do 2. If I gave you 7 years worth of statements, how many CFIs could you do? How many TIIs could you do? How many TFIs could you do? You got the message. Okay, so that's the key here. So again, I'm copying and pasting across the 3, just so I can copy and paste across the sheets. We're only going to end up with 2 years of CFI. All right, so let's start out the process with the income statement. Income statement's TII, and I start out with my NOPLAT, which is my operating profits after tax. And what I'm trying to get to is something called gross cash flow, which is the cash coming from the income statement, which is defined as NOPLAT plus depreciation. Now, depreciation is here, and I'm going to be adding my depreciation. So I have to make it a positive number if I'm going to be adding it back. But here's the key. Gross cash flow tells me how much cash I generate from my income statement. Right? So last week, I was dealing with a giant hospital system. They're about $4.6 billion worth of revenue. Right? And their CFO was talking to their top leaders in their hospital. And I was actually just there in the room. But one of the things he talked about is our hospital, and this is actually public data, basically makes about a 2% margin. Okay? So here's the thing. Hospitals, not-for-profit hospitals, don't make a lot of money. That's just the nature of not-for-profits. They're not trying to make a lot of money. But what he was trying to explain to them is there's actually something that the credit rating agencies look at called EBITDA, earnings before interest, depreciation, amortization. And as a not-for-profit, they don't pay taxes. And their EBITDA, which is your profit plus depreciation, is closer to 8%. So what he was trying to say is, look, the cash that we have to spend is not 2% because there's these non-cash items. The cash that we have to spend is 8% of our sales because that's the cash profit. That's gross cash flow. Right? That's the way it should be thought of and used as a business. Now, in the for-profit world, the metric that people will use, they'll call it EBITDA, EBITDA, earnings before interest, tax, depreciation, amortization. People will use that as a proxy for gross cash flow. But the problem with using EBITDA as a proxy for gross cash flow is that that is a pre-tax number, and we have to deal with taxes. So what do the accountants make us do? They make us take our EBITDA, you subtract the depreciation, so you calculate your taxes on the lower EBIT, but then you have to add back the non-cash depreciation. That is NOPLAT. Okay, so NOPLAT and EBITDA are in theory similar type numbers because they tell you how much you generate in cash flow, and that's why we use gross cash flow. But gross cash flow is the after-tax number from operations. EBITDA is the pre-tax number. They're going to be somewhere in the ballpark depending on the tax rate and the depreciation mix. But again, the real number we care about is gross cash flow because it's the gross cash flow that we're going to use to then go spend on other things. So this is a very key number for the business. So this is the gross cash flow for the 3 years. What are we spending on? Well, in operating activities, we spend on what's called gross investment. So gross investment is the reinvestment we're making into the business. Again, it's our change. This was the shortcut I gave you. Change in invested capital plus current year's depreciation. And free cash flow is the gross cash flow minus the gross investment. It's funny. So 2 years ago, one of my TAs said, if students get nothing else out of this entire class, I hope they get the concept of free cash flow, because that is so critical if you work in the finance profession in the real world, right? So back to this. What does negative 178 mean for gross investment in 2014? What does it mean to have a negative $178 million gross investment? Yeah.
Put more money into assets than money that you got from liabilities.
It's the opposite. Look at our free cash flow. Our free cash flow is higher than our gross cash flow. So it means we disinvested in the balance sheet. So when our gross investment is negative, it means we actually took money out of the assets, took money out of the capital of the business. We freed up cash. Versus 2015, 748, we put cash back into the balance sheet. We put cash back into the business. Right? So one of the things gross investment can tell us is, like I said, we had some disinvestment in 2014. Now, the challenge is we don't know what that disinvestment was. We do know there was disinvestment. This is why the granular approach to writing out the individual line items can eventually be helpful. Because if I see a negative investment, I'm like, gee, why is this company doing negative investments? Are they selling off assets? Are they actually just not spending money? Like, what's going on here? And that's where the granularity will help, right? Matter of fact, think about free cash flow. In 2014, this company, because they disinvested in the balance sheet, generated more cash than what they earned from their business. In 2015, they spent more than they earned from their business, so they were short, and they're going to go need to find that money someplace else. So again, it tells you a lot about what's happening in the business. More on this on Wednesday, right? But, so for purposes of the midterm, this is all you need to do for free cash flow. You can use the shortcut. You don't have to write it out in the granular fashion. But if you want to write it out in the granular fashion, there's it's not anything wrong with doing it that way. So let's do that. Add some rows here. All right. So, what is gross investment? Well, first of all, it's going to be our change in working capital. All right, so our working capital went from 810 to 767. So one of the first things we can see is that for both years, this company was reducing its cash tied up in working capital. Next, when we just look through each of the items, we have net PP&E. Well, the change in net PP&E is created by what's called capital expenditures, or CapEx for short. And again, if it's not given to us, we can solve for it. Solve for it is, we take our current year PP&E divided minus previous year plus current year's depreciation. So that is the CapEx. Next, we have our change in goodwill. Goodwill went from 300 to 250. Oh, sorry, 250 to 300. So goodwill went up by 50, and then it went up by 150. So good question. What's goodwill? What is goodwill, and where does it come from? Yeah.
It's like I guess it's the difference that they make up in the valuation when you don't have like a tangible asset. So they say like when Microsoft bought Skype, they added a ton of goodwill to it because it's not really worth that much and they can't justify the cash flows. So they basically say like we're adding this extra value because of.
But where does the amount of the extra value come from? So you're exactly right, but where does it come from? Is what?
Net present value?
No. It's actually more simplistic. Yeah.
Intangible items like the name, brand.
But how does it mechanically work? How does goodwill actually show up? What do you do? So when you do an acquisition, let's help you here. What you do is you're able to revalue the assets that the company has. All right, but basically it's going to be close to the book value. It's what they spent. And then you look at the price you paid. The difference between the price you paid and the tangible value of the assets that are already on the balance sheet, you have to plug to get the balance sheet to balance. That's called goodwill. So the key is goodwill's a plug. All right, now what causes you to pay more than the assets is the net present value of the cash flows is higher and you believe than what the company spent. But I'm just saying the actual mechanical way the accountants do it is it's literally just a plug between the price and the value of the assets acquired, which they can revalue at the time of the acquisition. But nonetheless, that difference is going to be called goodwill. So here's the key. Goodwill goes up when a company buys something. If it doesn't buy anything, it doesn't have goodwill and it doesn't go up. So one thing we can clearly see here for both years is this company bought somebody each year, or some buddies, that could be plural. All right, so there were 2 acquisitions at a minimum made. Now, here's the next thing. Goodwill, in theory, Modigliani-Miller theory, is operating. Okay? So this is the simple example I gave to the previous classes. So, I teach for a living. I need a computer to teach. So I got to go buy a computer. I go to Best Buy, I buy a computer. All right? I buy an operating asset which I use in my presentations to run my business, teaching. So therefore, it's a cost of doing business. It's an operating asset. I go to eBay. I buy a computer from somebody else. Well, at the end of the day, that's an operating asset too, because I'm buying a used computer, which I use to run my business, and therefore it's an operating asset. So it doesn't matter whether I bought the computer at Best Buy or whether I bought the computer on eBay. I'm basically using the computer to run my business, right? Well, the same thing is true. If you think about goodwill, what I'm doing is I'm buying people's inventory. I'm buying people's receivables. I'm buying people's plant, right? Why am I buying them? Because I'm going to use that inventory and that plant to make products that I now control as a normal course of my business. Now, typically acquisitions are at a premium, which means I'm paying more for the company that I'm buying than if I just built it myself, right? But the point is, in either case, it's operating. So goodwill is operating. All right, and is part of an operating investment. However, a nuance in the real world. If you look at the definition of free cash flow used by Bloomberg, right? So for example, I have a call later this week with the CFO of Raytheon, right? And they use the definition of free cash flow that is used in Bloomberg, which is basically gross cash flow minus gross investment excluding goodwill. Right? So the definition that's set up on Bloomberg is investment does not include acquisitions, because the idea is I have free cash flow, right? And the way that the CFO of Raytheon would think about this is I have free cash flow. With that free cash flow, I could either choose to reinvest it, I could choose to buy another company, I could choose to pay off my debt, I could choose to pay a dividend, I could choose to buy back stock. So it's my discretionary cash flow, and acquisitions is part of my discretionary cash flow. That's the way free cash flow is defined in the real world that most people will use, that you actually see the standard in Bloomberg. So if you look at the EEO screen and you look at the forecasted free cash flows the analysts are putting in there, they're not including acquisitions. Now here's the thing. Conceptually, I don't necessarily agree with that, but at least I accept that that's a difference in the real world, because as I said, if I buy a company versus I build the plant myself, either way, I'm using it for operating purposes, and I have to return the operating capital back to my investors. So what you'll see after the midterm is you will see the free cash flow before and after goodwill. All right, in this class, we will develop 2 free cash flows, before and after goodwill, because one will match what's in Bloomberg, the other will match what we do in the valuation. But what you'll find is the free cash flow after goodwill is the one that closer approximates the values of companies. Because whether investors say so or not, they are looking for the cash that you spend in acquisition as a cash flow that costs you to run your business that can't be distributed to the equity holders. So again, examples of nuances here, but regardless, that's what the goodwill represents. Here's where it also gets tricky. How does goodwill go down? Okay, but specifically, how do the accountants reduce goodwill? Let's say I don't sell the company. How does the goodwill go down? Yeah.
Amortization.
You don't amortize it anymore. You used to. It's now what's called impaired. It used to be amortized, but they changed the laws, and now it's impaired. So here's the deal. Goodwill could theoretically stay on your balance sheet forever. And when it's impaired, it's a paper write-off. We just say we own something and it's not worth as much, so we're going to write down the value on the paper. Nothing changes about the cash flows. And they made goodwill impairments non-tax deductible. So when you impair an asset on the balance sheet and you write down its value, you can't reduce your taxes. So the tricky thing about goodwill is when goodwill increases, we know it's a cash flow because we know that in order to add to your goodwill, that the accountants actually added the price you pay minus the assets and they added that in there. But when goodwill goes down, it's not a cash flow, it's an impairment, it's a write-off, and that is something that we have to be very cognizant about on the cash flow statement. So the one problem in the real world when you look at changes in goodwill is changes in goodwill that are positive add to gross investment. Changes in goodwill that are negative have no impact on cash flow whatsoever. Okay, so because again, it's impaired and it's a non-taxable item. So it used to be it was amortized and then taxed deductible, just like depreciation, which is why it used to be EBITDA, which is earnings before interest, tax, depreciation, amortization. But now the amortization of goodwill is no longer the case. It's impaired, it's not amortized, and it's not tax deductibles. We still call it EBITDA, but it's really EBIT without the A. Stop with the D. I guess I don't know if that's the way you'd actually pronounce that, but EBITDA, right, is really more of the case. All right, back to this. Changing goodwill. Next, in the interest of time, we'll move a little bit faster. What do we got here? TFI. Got change in goodwill. We got, what's next? Change in other assets, change in other long-term operating liabilities. So back to this. Change in other assets, change in other long-term operating liabilities. So my other assets went from 295, from 200, they went up by 95. And my other long-term liabilities went from 200 to 500. Now, here's where we have to make a choice about signs. Right? If I spend money on working capital, if I spend money on CapEx, if I buy companies, if I spend money in other assets, it's adding to my gross investment. If I don't pay my bills and I generate more liabilities, then that actually offsets the cash that I spend. Okay? So just don't pay your rent for a month and you actually have more cash in your account. Well, you add the liability because you still owe the money. So in this case, if I want to use the at sum function, then I would need to flip this sign. If I didn't want to use the at sum function and I just wanted to remember to subtract it, I'd have to remember to subtract it. As I said last week, I don't really care which way you do it, personal preference, but either way, you need to get to the negative 178. And you got to understand why you got to the 178. That was negative, because that's the correct answer. Okay? And that adds to the free cash flow because I'm disinvesting, and that adds to the gross investment because I'm investing in this year too. But that's the long method. By the way, the advantage of doing the short and the long method is, and this happened to me in the last class, because I got repetitive, I skipped the goodwill, forgot to put goodwill on there, and I screwed it up, and I could see that my shortcut didn't match my granular, and it was very apparent that I forgot to put goodwill in there, but it also helps you with mistakes, right? Because it's really easy when you're cutting and pasting a lot of things to make a mistake. You forget something, or worse, you copy and paste the wrong line item there, and then things don't add up, right? But if you copy and paste the line item in there that's wrong, and you don't try and balance it out, you have no idea that you made a mistake until it's probably too late for your career, right? So basically, it's more important to do the balancing because it means you're less likely to screw up. Anyways, free cash flow. Non-operating cash flows. Income statement. TII. Now again, if I wanted to short circuit this, I could just go straight to non-operating income. Right? That could make my life a little bit easier. But for your purposes, I'll show you the two line items independently. Here's the after-tax interest income. Here is the after-tax interest income. And here is the after-tax non-operating income. Those are my 2's. Right? And then I have my change. Look for my 2's. What do I have 2's to change on the balance sheet? Well, they're here. Change in excess cash. Change in equity investments. And change in non-operating liabilities. All right, so my excess cash went from 265 to 370. It went up by 105. Positive or negative? Okay. So here's the point. In terms of CFI, it has a negative impact. If I purchase a non-operating asset, I have less money to pay out to my investors. Excess cash is just another non-operating asset I'm purchasing. That's technically the way it's looked at. Whether I buy a piece of another business that I don't run, or whether I put money into a savings account somewhere, I'm basically purchasing another non-operating asset. Therefore, I'm reducing the cash available to pay out. So in this case, the sign needs to be flipped if I'm going to sum that, or I'd have to subtract it if I left it as a positive number. Change in equity investments. My equity investments went from 50 to 300. I spent $250 on equity investments. Well, that is going to reduce the cash available to pay out because I spent the money. My non-operating liabilities went from 50 to 30. Well, that freed up cash, 20 of cash. Because I basically, is that right? 50 to 30 of non-operating liabilities. Is that right? CFI sign? Just be positive or negative 20. Did I free up the cash? How do I pay my credit card? I got to spend the money. So does that add or subtract to my CFI? So, when I look at my CFI, I could sum these and call this non-operating cash flow. Cash flow, and that basically is that. So I have operating cash flow of 559. I have non-operating cash flow of negative 345. I ended up with CFI of 213.4. I have operating cash flow of negative 355. I have non-operating cash flow of 128. I have CFI of negative 227. Going across the statements, I generated this level of operating profit on these operating assets, which generated this cash flow. I have this non-operating income, which was based on these non-operating investments, which generated this non-operating cash flow. That's the revised consistency of the Modigliani-Miller format. That's what we need to be understanding for analytics. Questions about any of that? Because a variation of that will be on your exam next Wednesday. All right? So hopefully, since nobody had any questions, you've been paying attention, you understand what we just said. All right, so let's go on. Next, debt. equals TII. Anything that's a 3, well, the good news is my 3's after tax interest expense. TFI. Anything that's a 3 is a change. I have 2 3's, I have long-term debt, and I have short-term debt. So change in long-term debt, change in short-term debt. All right, my short-term, sorry, it's supposed to be short-term first, long-term second. All right, so back to debt. My short-term debt went from 80 to 240. And my long-term debt didn't change in the first year. So when I increase my short-term debt, is that a positive or negative number on the CFI? So it's also going to be a negative number for the long-term debt as well. So let's validate that. Negative 400 should mean what happened to our long-term debt in 2000 and what year was that? 15? What should happen? So did it add? Yes. So we can validate it the other way. Okay. Then we do our 4s. This was one of the tricks I told you about last week. We don't use net income for the income statement cash flow. We use dividends. So we have 2 dividends. We have the preferred and the common. Those are both outflows. So those are positive numbers. Right? Then we look, and I think I skipped something. There is a 4 that was on the income statement that I had skipped over, which was what? Minority interest. Those are also dividends. Those are dividends to our minority shareholders. So I can't forget to put those into the CFI. Now those are already after tax, so I don't have to tax impact those. And those are distributions, just like the preferred and the common dividends. So those are also positive numbers. Okay. Then I have, go back to this, change in minority interest. Change in common stock. What else do we have here? Change in preferred. I'd skip that. Let's put these in order. Change in preferred. I'll skip the change in retained earnings because remember we talked about that as trick number 2. It's a non-cash account, so change in non-cash accounts don't affect anything. And then we have change in treasury, thanks, which is the share repurchase contra account. Okay, so minority interest equals, it went from 300 to 300. But let's just think about this conceptually for the sign. If my minority interest increases, just like my debt increased, would the sign be positive or negative? So my minority interest goes from 300 to 400. Should that be a positive or negative impact on the CFI? All right, if it's a positive aspect in the CFI, that means that I have less minority interest, just like I'd have less debt because I actually paid it off. So it's got to be negative. So this one would have to have the sign flipped. If I owe the minority shareholders more money because I have more that I owe them, that I have more capital tied up in the company. Capital tied up in the company means negative, right? Because I'm getting cash from the minority shareholders to my business, right? So back to this. Good news is it's zero, so you don't have to worry about it for your homework assignment. But here, I'll go ahead and set it up. Okay, so
You
copy,
would flip it for minority interest.
just like you would for long-term and short-term debt. Okay, change in preferred equals, kind of like minority interest, no difference, just a common stock account. Or sorry, it's an equity account. So preferred, delta, same concept. What happens when the preferred increases? Well, if the preferred increases, then it needs to be a negative number. So in that case, just like debt increasing is a negative number, preferred increasing is a negative number, minority increasing is a negative number. So I have to flip the sign for the preferred. There we go. And that's my 4. And then same thing with issuing and buying back common shares. If I issue common stock, same thing. It's like issuing new debt. So minus, I'm going to start that. Current minus previous. Now treasury stock. Treasury stock occurs when? What causes treasury stock to show up in a balance sheet? Yes,
We buy back shares in the company.
correct. And it's a contra account. The primary reason it's a contra account is because common stock at par values at book value, treasury stock is the market value of what's purchased. So technically you could still have common stock outstanding and negative equity because you bought it back for more than you paid for. Okay, so basically that's why they treat as 2 separate accounts, because treasury stock is market value of what's paid. Now, here's the advantage from us from a cash flow perspective. If our treasury stock goes from -5 to -250, what does that tell you? What does that -245 tell you? Our treasury stock increased by 245 million? What?
The shareholders received 145 million.
Exactly. So therefore the sign should be
Positive.
exactly. It's distribution. And I think I got all the categories, so if I sum up all my categories and I didn't make any mistakes, then my CFI balances. And if I did make a mistake, then it doesn't balance, and then I go hunting. For that one, because I did a lot more detailed explanation, ended up taking about 40 minutes, but we still got 19 minutes left to finish our midterm. And that's with talking and explanations. Questions? Yes?
Will you put another example online?
I'm going to post at the end of today what I'll call a sample midterm, so you guys can practice on that one. And then we'll talk about it on Wednesday. Not graded, just to try yourself. And I strongly encourage you to try it yourself. Like, I'll also give you the sample midterm solution on Wednesday, but to be honest with you, you're better off trying to do it yourself before you see the solution, because otherwise, like, it doesn't really have a lot of learning. Now, we still got 5 more minutes to finish the economic profit statement. We're going to finish the economic profit statement, the 4th statement, that we didn't have time to finish last Wednesday right now. And that will definitely be on the midterm, and it's already part of the solution. Yeah.
On the term, do that everything labeled.
I will label it 1, 2, 3, 4. Absolutely. So, statement number 4, which we didn't have time to do last week because of the snow day, it's called economic profit. All right, again, we now have all the components, so it won't take us long to create it. So let's start creating it. So again, relative references for years. Right, and again, economic profit was explained in the book. Right, so I'm assuming you guys all know what it is. But basically, 2 methods to calculate economic profit. The cash flow method, the spread method. Start out with the dollar cash flow method. So, equals. They defined in the book as no plat minus capital charge. No plat is right here. So there's our no plat. And then we have to subtract our beginning of year capital charge. Right? Now, this is also from the readings 2 weeks ago when you guys learned about the difference between the enterprise DCF and the economic profit valuation models. When you were reading about that, it talked about how those two models only sync up when we use beginning of year ROIC and therefore beginning of year economic profit. So we're going to consistently follow that approach that was described in the book here in the analysis and analytics we do for EP. So beginning of year capital charge, how do we do it? It's relatively straightforward. We need to know what our invested capital was historically. So there was our invested capital. We need to know our WACC. The WACC was given here in the financials, 6%. So each year at 6%. And then we need to know our capital charge. So beginning of year capital charge, we just call it capital charge, equals 3460 times 6%. So this is our beginning of year EP. So here's the idea. In 2014, we used the 2013 capital charge. And the beginning of year economic profit is current year NOPLAT minus the capital charge based on our starting capital, which is the end of last year's capital, just like it explained in the book. Pretty straightforward. So that would be our EP for 2014. That would be our EP for 2015. All right, method number 2 is the spread method. To do the spread method, we look at our ROIC. What is our ROIC? Well, the advantage is it's right here, but what we do is we use the beginning of year ROIC for the same reason. And our beginning of year ROIC equals current year NOPLAT divided by last year's invested capital. We'll do that as a percent. Copy, paste. We use the same WACC, and that gets us something called a spread. So here's our WACC. Equals that. So our spread is the beginning of year ROIC minus the WACC. So our boy EP equals that spread times previous year's invested capital, and I have both methods which now balance. So in 2014, the business destroyed value. How much value did it destroy? It destroyed $46.6 million. In 2015, it destroyed value, $50.72 million. Why did it destroy value? Because the ROIC in 2014 was 4.65% against a cost of capital of 6. Why did it destroy value in 2015? Because the ROIC was 4.34% against a cost of capital of 6. That negative spread led to the destruction of value. EP is the one-period destruction of value. Or, in some cases, positive creation of value. So it's just a one-period change in your NPV. Yes?
How did you find the ROIC?
NOPLAT divided by invested capital. But in this case, when we use BOY, as the book talks about why we would use BOY, basically BOY means beginning of year. Beginning of year, January 1st, is the same as December 31st last year for all intents and purposes. So it's current year NOPLAT divided by previous year's invested capital. And as I said, the reason why we're using the BOY method is because it allows the two valuation methodologies that we are going to use this semester, the DCF and the EP valuation methodologies, which you're about to do, to sync up, right? And by the way, that will also be a midterm question to make sure that you truly understand all of that reading. Yes? So I just took the spread times the previous year's invested capital. And that's what I mean. If I did the current year's invested capital, I could do it current spread divided by current year's invested capital. That would not be the beginning of year method. That would be called the end of year method, EOY. Okay. Later in the semester, we will do both methods. But for now, this is the way I'm going to have you do it on the midterm. And it'll also be the same way in the practice midterm. It would have been the same way on your homework assignment. We didn't get to it, which is why I didn't put it on there, but it is in the homework assignment solution. I am going to take the file that I just created, which, by the way, this entire class has been recorded and will be posted on YouTube. But before I post it, I'm going to copy and paste and get rid of all the formulas. Okay, so you're going to get the numbers, but you're not going to get the formulas that I created in here. Now, the formulas are on the videos, but I'm not going to give them out, primarily because if I did this, what's the point of having the midterm? All right, I'm not going to give you the templated solution. All right, but I've given you everything you need to know to basically do well on the midterm, because this is part A, with just a few new categories of exactly what you have to do. And by the way, with all the explanations, we still have 12 minutes to spare before we would have to submit. So practice the midterm. You'll notice it gets a lot faster the next time you go through it. All right, not for a grade. We'll talk about the practice midterm as well and the analytics that go through all of this on Wednesday. Okay, have a good day.